Construction companies excluding Dilip Buildcon maintained double-digit growth momentum in Q4 FY22. However, growth momentum slowed compared to FY22 owing to government ban on construction activities in the NCR, slower execution by construction companies due to steep rise in raw material prices and relatively higher base in the corresponding quarter last year. But our conviction picks, KNR Construction, PNC Infratech, NCC and HG Infra posted better execution with revenues growing 17% on a year-on-year basis. Toll collections were affected by restrictions led by the third wave of COVID-19 in the early part of Q4. As the cases dropped in mid-February, traffic movement gained pace. IRB, which is one of the largest toll players, saw revenue growth moderate to 5% YOY to 510 crores in Q4 FY22. Prices of raw materials, steel, cement, diesel, they've all increased sharply, however, year-on-year. Construction companies negated some impact of hike in input costs by slowing down execution in the March 22 quarter. On an overall basis, companies in our tracking universe, ex-Dilip Buildcon, witnessed about 200 basis points increase in raw material costs YOY. While these companies have a pass-through clause in their contracts, it's not possible to pass on the entire raw material cost, especially in the short run. Higher raw material costs were offset by operating leverage owing to double-digit top-line growth and cost control measures by the construction companies. EBITDA margins of the universe dropped marginally by 20 bips. With double-digit EBITDA growth and lower depreciation and finance cost, these companies saw an uptick in profits. Lower taxation in some companies also boosted the profitability. Net profit of the universe grew by about 35% YOY. Infrastructure remains a key focus area for the government. Construction segment forms about 10% of the GDP and also creates demand in allied sectors such as metals and cement. It also is a key employment provider. Hence, we expect government to continue to support this sector. Rating agency ICRA believes that government's fiscal deficit would be around 6.5% of FY23 GDP without any cut in the spending compared to its original target of 6.4%. As such, we do not expect any material cutback in infra spending by the government as of now. Also, the government has crossed its national monetization program target of raising 88,000 crores by raising 1 lakh crore last fiscal by monetizing roads, power and mining of coal and minerals. National monetization program is an important financing option for the government for creating new infrastructure. Construction companies have a healthy order book of 2 to 4 times FY22 revenues, which provides healthy growth visibility in the medium term. Apart from the order backlog, construction companies have also indicated robust order inflow for the current financial year, which provides further confidence. Now, most companies in the construction universe have guided for better order inflows in FY23 versus FY22, indicating continued higher spends in the infrastructure space. Most of these companies expect double-digit revenue growth to sustain in FY23 as well. Raw materials such as steel have seen some price correction, while cement and crude prices have stabilized post the spurt that we saw when the Russia-Ukraine conflict began in late Feb 22. Also, construction companies have raw material pass-through clause in the contracts, and most companies have guided for maintaining the margins in the current fiscal. Raw material prices are unlikely to have material impact on the margins. We are positive on the prospects of construction space in the current market scenario, where other sectors are facing demand slowdown and heightened margin pressures. With revenue visibility over the medium term and no marginal effect on the margins, construction space should deliver relatively better earnings performance. We continue to prefer our conviction picks, which is HG Infra and Engineering, PNC Infratech and NCC. These companies have a strong balance sheet, proven execution track record, experience of pan-India execution and prudent project selection. These preferred picks have fallen about 20% since the start of 2022, which is marginally higher than Nifty's 13% fall in the same period. Also, the price to earnings valuations of these stocks are in the range of 6 to 9 times FY24 projected earnings, which are lower than historical averages and provide comfort. We recommend investors to utilize market weakness as an opportunity to add these stocks. We also like KNR Construction's management quality and business execution. However, KNR should be avoided as lack of high margin irrigation orders can lead to earnings pressure and relative stock underperformance.